Hey everyone, and welcome back. Today's video is of course stock market Q&A for the month of December 2020, the last one of the year. And we actually had a lot of really good questions come in this week. So I'm really excited to go through and answer some of these and provide some answers for you guys for some of your questions. Before we get into that, this week is a little bit different. As you can see, I don't have my editing computer in the back, and that's because this week it decided it didn't want to turn on. So thanks Apple for that. So it's getting repaired at the moment, which means this week, as you've seen from the video earlier in the week, I'm doing some less editing intensive videos where the last couple of days ago we did one where it was just a screen recording and showing you going through some numbers. And today, of course, we're doing our stock market Q&A. But next week we will be back, hopefully, if my computer is back, we will be back to some normal videos. Also, by the time you're seeing this, I probably have hit 50,000 subscribers, or at least I will be very, very close. So that is a crazy milestone, and I couldn't have done it without the people watching this video, particularly these stock market videos. It's mostly subscribers who are watching these. If you're not a subscriber, make sure you hit subscribe. Thanks everyone so much for the support over the past year, and of course over the past couple of years as we've been growing this channel. But with all of that said, let's jump into the first question. The first question we've got here is, why don't you deduct financial expenses too when calculating the free cash flow? So that's a good question. There's a couple of things to talk about here. When you mean financial expenses, there's kind of two costs related to financing, related to debt. There's of course paying down the principal of the debt, and then the interest payments. The interest payments are taken into account in the free cash flow calculation. So interest payments are a part of that first section of the cash flow statement, which is operating cash flows. So when you're taking the net operating cash flow, or the cash provided by operating activities, that's at the bottom of that first section, and then you're minusing capital expenditures, you actually are taking into account the interest expense. And then in terms of the principal, in terms of actually paying down the debt, I don't take it into account in the free cash flow figure specifically, but typically when I'm comparing the future cash flows of a business to the price that I'm paying for the business, I'm taking it into account in the price that I'm paying for the business. And what I mean by that is, whenever you're looking to use the discounted cash flow and you're assessing a business as if you're buying the whole business, you can compare it just to the market capitalization, which is basically the price of all of the shares added together. But probably a more accurate assessment would be to compare the future cash flows, to compare the buy price in the discounted cash flow to the enterprise value, which does take into account both the cash that you get when you're investing in the company, as well as the debt that the business has at the time. The other thing I want to mention is, a lot of the time I don't talk about enterprise value, because if you're following the entire strategy that I talk about, then you don't really need to do that. And the reason why is because we are looking for businesses with really low levels of debt, which means that typically speaking, the business you're investing in, if you're following my strategy, will have more cash and more current assets, more short-term assets to cover those debts. And as a result, the enterprise value will be not that much different to the market capitalization, and it's therefore not something you need to consider thoroughly. It is something you definitely need to take into account if you're looking to invest in a business that has a lot of debt, and certainly if it has more debt than cash, but that's just not the case with the safe businesses that we're looking to invest in. The next question that we've got here is how to identify competitive advantages of companies. Yeah, that's a really good question. I've actually got a couple of videos dedicated to looking at competitive advantages, or sometimes I call the video economic moat, which is Warren Buffett's term for competitive advantages. I'll leave a couple of those videos linked down in the description below if you want to check them out. But essentially, it's a two-step process. First, we want to do a qualitative analysis, which means we're just looking to the business to see what advantages we can identify. Come up with a hypothesis, come up with an opinion about what the advantages might be from your understanding of the business. And you can use something like Morningstar's list of typical economic moats. I'll link that down in the description below as well, to try and figure out which advantages the business might have. And then you need to do a quantitative moat analysis, which means you should download my spreadsheet. It's completely free. I'll leave it, lots of links in this video. I'll leave it linked down in the description below. You can put all the numbers into the spreadsheet, and we're basically looking for businesses that have consistently growing sales, earnings per share, equity, and cash flow for owners. If a business has 10% or more growth over time in those areas and it's consistent, then that is indicative of a business that has a distinct advantage. Because ultimately, if a business has an advantage, they they have something unique, then they are going to be consistently attracting more customers, growing their revenues, growing their profits, and growing the equity and cash flows within the business. The next question that we've got here is, you've probably answered this question in a video, but how long does it take for you to find a company to invest in? How do you go about finding a good company, a good investment, when many of the wonderful consumer-facing companies are priced very high, like that investment you made in Thor Industries? Thank you. And there was actually a comment below this comment that is related to this, so I'll read that out as well. And this person said, I add my vote to this question. For example, how did you find Thor Industries? How did that come to your attention? So in terms of how I typically go about finding businesses, typically speaking, I start with the industries that I understand, industries I'm interested in, and I just do a Google search to find a list of the publicly listed businesses in that industry. So really easy example, I like looking at restaurant businesses. I've analyzed probably most of the public US restaurant businesses and most of the Australian ones as well, because I think it's a relatively simple business model and I find it quite interesting. And if you just do a quick Google search for publicly listed US publicly listed restaurant chains, you will just find a list of I think it's about 30 or 40 different restaurant chains, and you can just start going through one by one and analyzing them that way. In terms of Thor Industries, it was a little bit different. Thor Industries came onto my radar because I was actually looking for businesses that Warren Buffett was invested in, that Berkshire Hathaway was invested in. And what I discovered was they had a small investment, well, small for Berkshire Hathaway, but they owned the entire business of Forest River, which was an RV company. It's the third biggest RV company in the US. And that piqued my interest to look into the RV industry. Of course, I couldn't invest in Forest River because Berkshire Hathaway owned it entirely. But there was a publicly listed business that was the largest in the industry, and that was Thor Industries. And it turned out it was also a fantastically run business. And the industry is set up in a way where there's basically two major competitors, Forest River and Thor Industries. Both of them make up about 80% of the US market. So as a result, they have a duopoly, not much competition in that space. And there was a lot of other characteristics, of course, that I liked about the business. And then to answer the part of your question about price, I mean, I've spoken about this in the past couple of videos about how most of the time, really great businesses, their prices are just really high because people are attracted to great businesses. That's just the nature of investing. If you find a great business, most of the time, if you invest in that business, you're going to make a pretty low return because everyone else recognizes that it's a good business and they're willing to pay up to invest in that business. So you just have to wait for a short-term event to come around. For Thor Industries, it was the end of the RV cycle. They had a ton of sales in 2017. Then it dropped off substantially in 2018. At the moment, it's for a lot of businesses, it's the pandemic that's impacting their business. And at some point in the future, it will be something else for different industries over time. And if you just have a watch list of really great businesses, every now and then, one or two of them, or maybe just one of them, once a year, will become cheap enough for you to invest. And those are the businesses that you go ahead and invest in. And the thing to remember is that when you look at like the S&P 500, for example, or the ASX 500 or the All Ordinaries, and you look at the chart over time and you see that, yeah, we had a big drop in March, but besides that, there hasn't been that much volatility, right? The stock market's kind of just gone up consistently. But on an individual business basis, individual stocks move around a lot, right? So there's a lot more opportunity to get into businesses cheap when you're looking at an individual business basis. And even though at the time when you're looking at a certain industry, maybe you're looking at Facebook and Google, for example, you might think, how on earth are these businesses ever going to get cheap enough? What's going to cause them to get cheap enough? But things happen. Even for Texas Roadhouse, for example, that restaurant was doing terrifically well. And then there was just a labor shortage in the restaurant for entry-level employees, and their costs went up and the stock price went down 40%. So that's something that no one, really foresaw coming, but it's something that happens. And then over time, wages come back down and costs improve for those businesses. So little things like that do happen over time. You just have to have patience. And it's really hard if you've only been investing for a few months, it's hard to have the patience to think, okay, I might have to wait a year before I make an investment. But if you can have that mindset where you might find one or two really good ideas per year, or maybe even less than that in certain years, then you will do very, very well over time. The next question that we've got here is great value in your videos, Hamish. Thank you. Well, I appreciate that. Thank you very much. My question is, how do you read the activities of key value investors like Li Lu, who seem to take positions in great companies, Facebook and Google, for example, but at significantly higher valuations? I understand they play a different game to me and you, but their valuations are still too high. Yeah, I mean, that's something that you're going to see over time, right? You're going to see investors, big successful investors, invest in companies that doesn't really make sense to you. And I think the whole point is that when you're investing when you're doing value investing, you're coming up with your own opinion about where you think those businesses will be in the future. And if someone like Li Lu is investing, or Seth Klarman, for example, is investing in Facebook and Google, and you personally think they're too expensive, well, that's okay for you to think they're too expensive. They just might have a higher projection for where that business will be in the future. Maybe they see a faster runway for Facebook moving into payments, for example. Maybe their advertising business won't grow at much more than 8 to 12% per year, but maybe Facebook's moving into the payments industry really rapidly, and that's something they see causing a 2 to 4x in their profits over the next couple of years, or the next 5 years. I don't know. That's not my view on Facebook and Google at the moment, but that's where you get kind of different valuations from different investors. And ultimately, I think you should just come up with your own opinions. If you think Facebook and Google is too expensive, then don't invest in it just because a big investor is going after it. And the same thing is true on the other side. If you find a business and you think it's cheap, don't avoid it just because no successful investors are going after that business. Ultimately, I think you should just come up with your own opinions. And the other thing to remember is that as an individual investor with a relatively small amount of money compared to some of these big guys, you can look at smaller businesses. So maybe Facebook and Google is the cheapest looking business at that size for people trying to invest a couple $100 million. Whereas for us, we can look at smaller businesses that are a couple $1 billion in size, and maybe those are more attractive than the Facebook and Google, but because they're investing more money, they can't even consider investing in those companies. So that's something to also think about. The next question that we've got here is, I know it's important to follow the key indicators of a business. How do you identify the key indicators of a business? Annual report for the business, annual reports of concurrent other sources. Thanks for your content you are sharing. Keep going. Yeah, I think this is something to really consider. I think I have this question quite a lot come to me about finding the key drivers of the business in the future that we then use to estimate future cash flows. Basically, there's a couple of places that you can get this. I think a really sneaky shortcut way to find these is to go to the quarterly reports in the press releases. And you'll notice that businesses provide some dot points at the top of the press release that are kind of highlights. And that in those highlights are usually the key drivers that management believes will influence the business in the future. So if you look at a restaurant company, for example, in those dot points, you will see comparable store sales growth. You will see maybe average restaurant sales. You will see how many restaurants they opened during the period, things like that. Maybe their restaurant margins is probably another one. And then you know that those are the key areas that are influencing the business's profitability over time. And that's typically the place that you can go to kind of get a quick shortcut view at what the key business indicators might be. And then beyond that, it's just going to be reading annual reports, looking through investor presentations, developing your understanding of the business, and then reaching your own conclusion about what you think is driving that business forward. But usually it will line up with what management is putting in those highlights in the press release. The next question that we have here is thoughts on coffee can portfolio, never sell. I've never heard of that term before, by the way, but I presume you mean buying and holding businesses for as long as possible. Due to tax implications, compounding, chance of a bagger, avoiding fees, etc. Buffett applies many principles of a coffee can portfolio. Monish Pabrai has indicated a change towards this style. Is this something that you have looked into? Yeah, so this is something that basically I try to live by. I try and only invest in businesses that I think will be great businesses to hold for not only just the next 10 years, but beyond, right? I'm looking to invest in a small number of companies that I don't have to swap and change all the time. And I think it just makes sense to invest that way. Some of the things you listed are certainly factors that influence that, but ultimately you want a portfolio of a small number of businesses that you deeply understand, that you don't really need to change all that much, and that you don't need to be constantly watching and getting in and out of businesses all the time. So I kind of have the approach of being very, very patient and disciplined in which businesses I invest in. And when I do find something that I really, really like, I go heavy into it, and I won't be looking to sell that business unless something changes within it, right? Unless the stock price goes up a huge amount and it's much better for me to hold cash than to continue holding that investment. So in other words, the long-term return is probably going to be single digits or even worse, negative. Or if something fundamentally changes in the business, which of course does happen when you're investing over a decade, 2 decades, businesses change. Businesses that were once great will no longer be great. They'll lose their competitive advantages. The management team will change, and maybe they were a great management team, but they're not anymore. And things like that will ultimately cause you to need to sell some investments, but the aim is that you don't have to. And if you can get a couple like Buffett has had, where he's had to not sell them, like an American Express that I think he bought in the 70s or the 60s, the Coca-Cola investment that he bought in the 80s and that he was tracking since, he was a little kid. If you can get a couple of those investments where you just hold them over your lifetime, you will do very, very well over time. And then the last question that we have time for here comes from Investing with Tom. Thoughts on reducing the discount rate in your valuations with interest rates effectively at 0? Or are you simply using the same rates as always? Also, congrats on the upcoming 50,000 subscribers. Thank you, Tom. I appreciate it. It's always good to see a question coming in from you. So in terms of wanting to make a significant investment, if I'm going to put 15 or 20% of my portfolio into a new business, then I want the same target return that I'm targeting, which is a 15% return with a 50% margin of safety, or very close to a 50% margin of safety. With that said, if I find myself in too much cash, which nowadays is if I have more than 50% cash, I want to put money into the market, then I will put little bits and pieces into businesses at a lower rate, but I'm still going to be holding a significant amount of cash waiting for those opportunities where I can get my 15% return plus a 50% margin of safety. And while it is really challenging to sit with quite a large amount of cash while stocks continue to go up, historically speaking, a zero interest rate environment has not been sustainable. Some people are suggesting that we might see this for a very, very long time, but with the amount of spending and money printing that's going on at the moment, I have to believe that it's only a matter of time before we see some inflation pick up. That's going to cause the Federal Reserve to need to raise those interest rates, and that's going to put downward pressure on stocks. I think that's something we're going to see over the next few years. I would not be surprised to see the stock market move sideways for the next 10 years. But even if the stock market moves sideways for the next 10 years, as I mentioned earlier, individual businesses will be volatile within that. And there will be opportunities, maybe not very frequently, but that's okay. Even if it's one good idea, one good investment per year or less, I can still put a substantial amount of money into those. And so far, that's worked fine for me. So we'll see how that goes in the future. But I'm very confident that I will be continuing to be able to find enough good investments to build a solid portfolio over the long term. So that's all the questions that we had time for today. And thanks everyone for asking a question. I apologize that I couldn't get to all of them. And as always, if you want to know how to ask a question in next month's video, which will be in January in 2021, the first video of next year, then the first thing you need to do is be subscribed. Hit that notification bell icon next to the subscription button and make sure you have all of your notifications turned on. And then in about 4 weeks time, I'll be making a post on the community board of my channel. And if you're subscribed, if you have notifications turned on, you will be notified when I make that post on your phone, on your laptop, and you can leave your questions on that post. But other than that, hope you guys have a great day, and I'll see you in the next video.